Hey, Daniel, I'm going to tell you a little story. A friend of mine was recently shopping for a car. He and his neighbor, who have similar jobs and similar incomes, went to the same dealership to buy the same model car. My friend got a loan with a 6% interest rate, but that neighbor got one for 9%.
Wow. What was the reason for the difference?
Only difference was their credit scores. My friend has a credit score in the high 700s, but his neighbor was in the low 600. That one number was the only thing separating them.
And that is a perfect real-world example of what we're talking about today. Average credit scores range from 300 to 850. The lower the credit score, the higher the interest rate. That 3% difference could cost the neighbor thousands of dollars over the time of his loan. Your credit score is one of the most important and most powerful numbers in your financial life. Welcome back to Making Sense of Your Sense. I'm Daniel Hill.
And I'm Shanna Browning. Today, we're going to pull back that curtain on that mysterious 3-digit number that holds so much influence, your credit score. It can feel like a secret grade that just follows you around, but it's really not as complicated as it seems.
It's not a grade on your character or your worth as a person. It's simply a data-driven summary of your history as a borrower. Think of it as your personal financial report card. A high score tells lenders you're a reliable bet, and they reward that reliability with a better interest rate and better terms.
So actually, what goes into that score? It's not a secret formula, and lenders are very transparent about the 5 key ingredients. But let's start with the most important one.
The biggest piece of the pie, making up about 35% of your score, is your payment history. It's a simple question with a huge impact. Do you pay your bills on time? Every single payment? From your mortgage to your credit card to your student loan, it's all reported to the credit bureaus.
So what constitutes a late payment in the eyes of the credit bureaus?
A payment isn't reported as late the day after it's due. It typically has to be at least 30 days past the due date to be reported. But once it is, that one 30-day late payment can cause a significant drop in your score, especially if you have an otherwise pristine record. And that negative mark can stay on your credit report for a full 7 years.
So what I'm hearing you say is consistency is everything. You can't undo a past late payment. You just have to start building a new long track record of being on time every single time.
Exactly. It's the absolute foundation of a healthy score. Now, the second biggest ingredient, at about 30%, is your amounts owed, more commonly known as your credit utilization. This mainly applies to your revolving credit like credit cards and lines of credit.
So what's being measured here?
It's the amount of credit you're currently using compared to your total credit limit. For example, if you have a single credit card with a $10,000 limit and your statement balance is $5,000, your credit utilization is 50%.
But being in this banking industry, I've always heard you should keep that utilization below 30%. Is that a hard rule?
It's a very strong guideline. From a lender's perspective, a person who has maxed out all their credit cards is statistically more likely to miss a future payment than someone who is using their credit sparingly. It signals a higher level of financial stress. People with the highest credit scores often keep their overall utilization below, let's say, 10%. This doesn't mean you can't use your cards. It just means you should aim to pay down the balance before the statement closes to keep that reported number low. So those two habits, paying on time and keeping balances low, make up nearly 2/3 of your entire score. That's huge. Now, let's talk about the other 3 factors.
And what's the next biggest piece?
Next, coming in at 15%, is the length of your credit history. Lenders like to see a long, stable track record of responsible borrowing. This factor looks at the average age of all your open accounts as well as the age of your oldest account.
This is why the common advice to cut up all your credit cards and close the accounts can sometimes backfire, right?
Exactly. Let's say your very first credit card is one you opened in college 15 years ago. Even if you don't use it much, that account is an anchor of stability on your report. If you close it, you might erase 15 years of positive payment history, which can shorten the average age of your accounts and cause your score to dip. It's often better to keep that old no annual fee card open, even if you just use it for small reoccurring payments once a month to keep it active.
And that's a great myth to bust. So what makes up that final 20%?
The last 20% is split evenly between two factors. About 10% is your credit mix. Lenders like to see that you can responsibly handle different types of credit. An installment loan, a car loan, or a mortgage has a fixed payment for a set term. Revolving credit, like a credit card, has a variable payment. Having a mix of both shows that you are a versatile and responsible borrower.
And the final 10%?
That final 10% is new credit. This is about how often you apply for new credit. Every time you apply for a loan or a credit card, it typically generates a hard inquiry on your report. 1 or 2 inquiries is no big deal. But if you apply for 5 new credit cards in a month, it can signal to lenders that you might be in financial trouble or taking on too much debt too quickly, which can cause a temporary dip in your score. Shanna, let's bust another common myth. Does checking my own credit score lower it?
Such a fantastic question. And the answer is a definite no. When you check your own score or your own credit report, it's considered a soft inquiry. You can check it every single day and it will have zero impact on your credit score. It's only when a lender pulls your credit for the purpose of making a lending decision that counts as a hard inquiry, as you mentioned earlier.
So being informed is completely harmless. Another one. Do I need to carry a balance on my credit card from month to month to build my score?
Absolutely not. This is one of the most persistent and costly myths out there. You do not need to pay a penny in interest to build a great credit score. The credit bureaus only care that you use the card and you pay that bill on time. Paying your statement balance in full every month is truly the best possible habit for both your credit score and your wallet.
So let's bring it all together. If someone wants to improve their score, what are the 2 most impactful things they can do starting today?
So the 2 most impactful actions are directly tied to the 2 biggest factors. First, set up automatic payments for at least the minimum amount due on all your bills. This creates a safety net to ensure you are never ever late. You can always go in and pay more, but the automatic payment guarantees your perfect payment history. And second, focus on your credit utilization. If you have balances on multiple cards, create a plan to aggressively pay them down, perhaps focusing on the card with the high interest rate first.
So to recap, the 5 ingredients: pay your bills on time, every time, it's 35%. Keep your credit card balances low, about 30%. Let your history grow by keeping old accounts open, it's another 15%. Have a healthy mix of credit types, 10%. And apply for new credit sparingly, that's the final 10%.
And that formula right there is the formula for success. And it leads directly to this week's actionable tip.
Your action item this week is to pull your own credit score. You are legally entitled to a free copy of your full credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, once a year.
The only official government authorized site for this is annualcreditreport.com. This week, don't worry about the 3-digit score itself. We want you to focus on the raw data in the report. Download your report from at least one of the bureaus and read through it line by line with a highlighter.
Look for anything that seems off. Is there an account listed that you don't recognize? That could be a sign of fraud. Is there a payment marked as late that you know you paid on time? Is a credit limit being reported incorrectly, making your utilization seem higher than it is?
As Daniel and I have seen in our years combined of banking, errors are more common than you'd think. Formally disputing an error through the Bureau's website is a free process and is one of the quickest ways to potentially see a significant score improvement. Knowledge is power, and knowing exactly what's in your report is the first step of taking control of your score.
Next week, we have our first guest. First Century Bank President and CEO Rob Barger will be here to discuss the simple but powerful habit of paying yourself first, which is the key to having money to save and pay down debt.
Subscribe so you don't miss it, and send your questions to podcast@fcbtn.com. As always, thanks for listening.